Thank you, and good afternoon, everyone. I appreciate the opportunity to speak at this QED event. We've attended them in the past and find them quite valuable, so the ability to provide our view. And yes, I am from the United States, but we also manage products here in the European Union. So I think we have positions that are equivalent across both sets of domiciles. I will refer you to a position paper that was put into your conference materials with regard to Federated's positions on the debate between CNAV and VNAV, and in particular on a broader basis across the regulations that have been put forth by the Commission at this point. It's very short and sweet. It's a one-pager. It's very easy to kind of go through and discern where we stand. And it's probably not surprising when you actually go through and do read that. As being having the distinguished place of being the last speaker in a panel of 10, to include our esteemed moderator, basically I think I was starting to put agreed, disagreed, and then I was going to list names, and that was going to be my presentation, but I thought that's probably not appropriate. I don't necessarily think that would be the best thing to do. So instead, I'll probably put forth some of the ideas that have been brought about by others, which we agree with, and we'll add supporting arguments to those, as well as rebutting some of the ones that we necessarily are not in place or don't make sense going forward. I will explain a few of the unique slides that we have here that are a little bit different from some of the other ones, but for the most part, you'll find the presentation material on the slides within your handout and pretty self-explanatory. Just by way of background, Federated is a asset management firm that operates in the United States as well as Europe. We're the third largest money market fund operator on a global basis, currently managing about $271 billion worth of assets in the money market sector. We've been in the European domiciles for 25 years. We operate funds both covered by the Irish authority as well as the UK authority, and we've been in the United States since the business started, with the oldest fund in that marketplace at 40 years old at this point. We do, as Jennifer mentioned, support reform for money market regulation and feel that there's a whole lot of great information that is in the proposal by the European Commission that in fact will provide stability and accessibility for this product for years to come in the European Union. But we also reject some of the proposals that have been brought forward. Generally speaking, we support those types of reforms that have been mentioned that with regard to the portfolio composition of the funds themselves. So any type of product enhancement with regard to liquidity, with regard to diversity. So increasing liquidity, improving the diversity within the product, mitigating some of the interest rate risk by putting maturity limits, weighted average life limits. Those are all ideas and proposals that to us make a huge amount of sense in how the day-to-day management of these portfolios is conducted by various firms throughout the world. Stress testing is another area that we think is hugely helpful, not only in the context in providing the board and the regulators with information that shows what kinds of stresses can be endured by these products, but it's also very helpful to the portfolio management team and the investment team to try to avoid these stressful situations and not get into any type of a situation that would potentially take you down that path of breaking one of those stress tests. Disclosure is another area that we think is hugely positive in the context of reform. Providing information on a regular basis in a consistent format to the regulators as well as to the public is something that we find very helpful. One of the reasons why I think investors left the money market fund product that were invested in prime securities in 2008, that included both the CNAV and the VNAV products, was because they weren't quite sure what they knew they had, those that held Lehman, because that was obviously disclosed in a stressful way, but they didn't necessarily know what else was owned in the portfolio and whether it could be problematic. So it was one of the reasons why investors left prime money market funds and went into government money market funds. There was considered more safety in the underlying investments within a government money market fund, if in fact you are comfortable at that point with the ownership of Fannie and Freddie and some of the other governmental entities at that point. We also have found that better disclosure and informational content by the investors keeps that run from happening. If you contrast what happened in 2008 to the response by underlying shareholders of prime money market funds to the Euro crisis, as it started to unfold in 2010, as it came to one head in 2011 and another head in 2012. So we've had different phases of that European banking and debt crisis. All of those were kind of blinked at from an understanding of the underlying shareholders of these products. There was not mass movement out of these products at that period of time, which I think is a good reflection on the additional transparency and disclosure that's been put forth by the fund companies, and that will continue to be enhanced, especially here in Europe, in order to provide more of that stability that we need in the product. We also think some of the amendments that have been brought forth by several members of Parliament that would be designed to enhance the fund board's ability to manage their funds in times of stress. And this refers to some of the things that again, Jennifer was putting forth in her explanations. The liquidity fees, gates on a discretionary basis, and how those work, we think are also very positive disclosure or positive proposals, and definitely are in support of those. The ones that we reject at this point in time are definitely revolving around the capital side of the equation. Capital offers the potential from a regulatory arbitrage perspective. We believe it creates moral hazard, which would increase the investment risk in the product as opposed to decrease it. It creates operational concerns. The modification of the constant NAV into something that is not a constant NAV or that relies upon the capital is problematic. And ultimately, when you look at what's been put forth on a 3% basis for the level of capital enhancement, that represents about 30 years of earnings for those funds. So it's just not feasible from an economic perspective. If the CNAV industry goes by way of capital only or conversion to VNAV, we think the results in the marketplace are much less competition, higher cost, less availability of short-term financing, and essentially greater systemic risk, which seems to be intimately against the broader rules of reducing the systemic risk in the marketplace.